What's good, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Make sure you hit that notification bell next to subscribe so you can get the instant notifications whenever I actually drop an episode. This episode, we're going to focus on valuation. And by valuation, we're going to focus on one metric. That's the PE ratio. We're going to talk about what the PE ratio is, how to define it, and is the PE ratio still relevant for us as investors? Let's get into it. So, what is PE ratio? All PE ratio is the price per earnings ratio. So to get the PE ratio, you would take the price of the stock and you would divide it by the earnings that the company had. Now you will break down the earnings in terms of EPS, which stands for earnings per share, which pretty much is just how much profit the company made per share. So to get EPS, you would take the profit that the company made after taxes and you would divide it by the shares outstanding to get how much the company made per share. Now the shares outstanding are just the amount of shares that the company made available for the general public to purchase. So let's break it down and let's do an example. So to calculate EPS, let's say the company had $100 in profit. And let's say the company had 10 shares outstanding. So you would take the $100 in profit and you would divide it by the 10 shares outstanding. So that means the company had $10 per share, right? That's what the company made, that they have an EPS of $10. Okay, so let's put it into the PE ratio multiple, okay? So let's say that a company has a $1,000 stock price, right? Let's say the stock price is $1,000 and let's say the company has an EPS of $10 per share. You would take the $1,000 stock price divided by the $10 in EPS, and that will give you a 100 PE ratio. Now, what does the 100 PE ratio mean? Essentially, this ratio tells investors how much they will be paying for $1 of the company's profit. And the PE ratio is a metric that is used to determine if a business is overvalued or undervalued. Generally, you want the PE ratio to be low and not high because that indicates that you are paying less for $1 of a company's profit than more for $1 of a company's profit. Now, is the PE ratio still relevant for us as investors? Why, yes, it is. Institutions use PE ratio to determine the value of a business. Institutions control the market, and they're not going to overpay for a business. So institutions need to see earnings for a business increasing year over year before they can justify putting money into it, which therefore would increase the stock price and then increase the PE ratio. But there's one thing that you need to really keep in mind, and this is the most important thing in terms of using PE ratio. You can only use PE ratio when comparing businesses in the same industry. So let me give you an example. Let's look at the NBA, okay? We respect players like Wilt Chamberlain, Bill Russell, Oscar Robertson, Jerry West, Elgin Baylor, right? Those guys were some of the best players that ever play in the game, but they were playing in the 50s, 60s, and 70s. It was a totally different game. Most of those guys were playing before the three-point line was even instituted into the game. So we can't really compare those guys to Steph Curry and Kawhi Leonard and LeBron James and Kevin Durant and those guys, because those guys play in a different era. Competition is different, coaching is different, the style of play. So even though we love these guys and we respect these guys for what they did for the game, we can't really compare them because it's just totally different. Same thing with businesses. I can't compare Target's business to Caterpillar's business. Why is that? Because they're in different industries. Target sells beauty products, they sell groceries, they sell clothes, they sell electronics. they sell things that retail shoppers will need to go get, right? Caterpillar, they sell machines. So the way they make money, the profit that they can generate, the margins are totally different. Which the margin is pretty much for every dollar that I spend, how much am I getting back? And so we can't really compare the margins of Target versus the margins of Caterpillar. But you can compare Coca-Cola to Pepsi. You can compare AMD to Nvidia. You can compare Apple to Microsoft. And you can compare Nike to Lululemon. Those are businesses that are in the exact same industry. So you want to make sure that you are comparing competitors with each other to make sure that the business is actually going to outgrow its competitors, and make sure that the business is a leader in its industry, preferably top 2, because you really want to be investing in the best businesses out there. Also, another thing that I want to mention is that don't get tied down to PE ratio either. Okay, it's a very important metric, but it's not the end all be all when investing into a business. There are so many other facets that you need to take into consideration before investing into a business. This is just one tool in your toolbox that you'll need to be successful as an investor. As always, I thank y'all for stopping by the channel and listening to the podcast. Please like, please subscribe. Make sure you hit that notification bell so you can know whenever I'm coming on to give you this game. All right? Please reach out to me in the comments and let me know if you didn't know what PE ratio was before, but now you understand what it is now since you've watched the video. Let me know if I did a good job explaining this and if you think PE ratio is important as investors. As always, don't pay for it. Trade for it. I'll catch y'all on the next one.